How do founders choose the right debt financing? Imagine you're building a house. You need funds to get the project off the ground, but you also want to keep control of your design and style. Choosing the right debt financing is just like selecting the best loan for your house. It can make or break your growth plans. First, you need to look at your startup's current financial health. Do you have steady cash flow or assets to offer as collateral? If yes, a traditional bank loan might be a good fit. These loans usually have fixed interest rates and repayment schedules, but they often requiring a solid credit history and tangible assets like property or equipment. If your business is still early and lacks collateral, venture debt could be better. Venture debt is designed for startups that have already raised equity funding and show high growth potential. It usually comes with higher interest rates and may include warrants, which are options to buy equity later. This type of debt helps with short-term needs like hiring or product development without diluting ownership. Another option to consider is lines of credit or debt as a service. These are flexible and can be used for managing cash flow fluctuations. They work well if your revenue streams are irregular. You might also look into alternative debt options like merchant cash advances or revenue-based financing. These are suited for startups with unpredictable income but tend to have higher costs. Preserving ownership and control is a big reason founders choose debt over equity. When you take on debt, you do not give away shares, so you keep decision-making power. However, some debt agreements include warrants or covenants that could influence control indirectly. Speed and cost are also important. Debt financing usually takes less time and costs less in legal fees than raising equity. If you need quick access to funds to hit a growth milestone, debt can be the faster route. But you must honestly assess your ability to make regular payments. If your cash flow is uncertain, debt could become a burden. Founders often use debt for specific short-term goals like expanding marketing, hiring key staff, or reaching product milestones. It's important to match the loan amount and term length with these goals to avoid overborrowing or cash flow problems. Building relationships with lenders who understand your industry and growth stage can help you get better terms. Networking with lenders specializing in startup or venture debt can open doors to future funding and advice. Many startups also combine debt with equity funding. This approach helps extend your runway without giving up too much ownership. You need to evaluate how much equity you have already raised and whether taking on debt makes sense to support your growth plans. In practice, founders analyze their financial metrics, research different debt products, compare interest rates and terms, and consider how each option impacts ownership and future fundraising. Talking to advisors or industry contacts can help you negotiate better terms. The goal is to pick debt that aligns with your capital needs, repayment ability, and long-term business goals. By following this process, founders can choose debt financing that supports their growth while keeping control and setting up for future investment rounds.